Good morning, everybody. I was busy accepting people. We are 37 additional clients on the call. Welcome from the team of SIA. We are extremely happy to have you all here. We have a pretty tight agenda. That's why I would like to start immediately with Carlos. But before that, just be aware that this event is recorded, and we will have then the option that everybody else can then also listen to it if they have not chance to listen to all of it, or your friends. With that, Carlos, I think we would like to start.
Yes, good morning to everybody. We're going to discuss very briefly three kind of macro things, which are the situation with COVID, of course, the inflation that we're seeing and that everybody's talking about, and a little bit about the energy transition that was pretty much in the news the last 2 weeks, and which affects, well, all markets and certainly many of our investments, as will be discussed later on. So as you can see on the third slide, actually, Alex, can you move the slides? No, the third. Voila. We can see that, well, as we all know, there is an increase in cases mostly throughout Europe. People are talking about the fifth wave. I mean, depends how you count, but on this chart, you can see it's kind of the fifth. So that is a fact. But the big difference in this wave with certainly the early ones and even the previous one is the enormous amount of people who have been vaccinated in the meantime. And what we see is that the two countries, which for a number of reasons were the early ones to go through this wave, the wave has pretty much, in the case of Israel, almost disappeared. And in the case of the UK, is on the way down, without creating much of an economic impact, because nothing has been locked down, the flights have been reopened, and life is pretty close to what it used to be before the pandemic. Now, the reason for that, you can see on the UK chart, is that the amount of cases goes down as people get older, because the older people are the more vaccinated ones. Now, this is very, very important, because it is only really statistically that for older people, the COVID was a serious health problem. Obviously, young people can have very serious problems too, but that is true. If we can go to the next slide, that is true even with the case of the flu. So it is very important to realize that the number that the press, the media concentrates on, which is the amount of new positive cases of infection, is probably not that important, obviously. Every year, millions and millions of people are infected with the flu, and nobody talks about it, we just suffer it from time to time. Because the flu, it's only really bad, and it is really bad. I mean, it kills lots and lots of people every year, but statistically not that many, and it really affects older and weaker people. Now, this virus is very fast becoming something very similar, something that is not a pandemic, but rather endemic, so something that is there, it's always there. And according to some studies, vaccinated people run now health risks, which are about less than half than what we run every year from the flu. And you can see that in this chart in the UK, but you can find it very similar numbers everywhere, is that although infections are going up in this fifth wave, hospital admissions, and even more important, deaths, are much, much lower. So they are not going up as much, because the older people are vaccinated, and the younger people who are less vaccinated do not catch such a serious case of the disease often. So important also to realize that now, for the first time, I mean, at the beginning we said this would be earlier than the vaccines. It's not been like this, but it has arrived. It's the treatments. Now the Merck pill has been now approved in the US. The Pfizer pill to treat the symptoms and to treat the disease is apparently even much more efficient or efficacious. And the Merck pill was approved yesterday, and the Pfizer pill is going to be approved very shortly. These are just a simple pill that you take as soon as the symptoms start, and in the case of Pfizer, reduces serious illness by more than 90%, which, by the way, is not the case yet with the flu. And an interesting side benefit, if we can say, of this pandemic is that the research on how to treat viruses in general, including the flu, which is the worst one, but also HIV that creates AIDS, etc., has advanced a lot. So we may end up coming out of this not only for a good treatment and cures for COVID-19, but even for the flu, HIV, and other things. It's interesting to see also that statistically we're at the very end of this problem. If you take the UK, and it is true, but this is just the number I found, but it is true almost everywhere. The number of people, I mean, the percentage of people with antibodies, either through vaccination or through recovering from the disease itself, is now 93%. And people with that high number of antibodies can and do get sick, but very, very few of them, and in most cases, not seriously. So this is going to be an endemic disease for which there will be treatments like others. And the economic impact, even if now very, very short term, we see in the least vaccinated countries in Europe, like Germany, Austria, particularly Eastern Switzerland, things are going up. But as I said, they are not going up that much in terms of hospitalization and serious cases. In any case, they're seriously going down. So we truly believe that from an economic point of view, we have seen the end of this thing. If we go next topic on inflation, well, it is obviously that inflation is picking up in many, many things. Lumber, if you remember last year, was the first thing that came out in the news as prices suddenly explode, because when the lockdown started, I mean, this is US prices. We use less lumber in Europe for construction. We tend to use bricks and cement. They use wood for the houses, but it went through the roof as people just wanted to improve things, and I mean, I couldn't go to the office, so let's fix the kitchen, you know. But then you see what happened, it went down. And the same thing has happened with coal. China suddenly found itself without coal and with even some blackouts. So the Chinese government decided to immediately reopen the mines that had been closed based on CO2 emissions and pollution in general. Decided to reopen them, and then the crisis was over. Same thing we can see with the Baltic Dry Index, which is the index that measures the cost of transporting mostly bulk materials like coal or iron ore across the seas. We can see the same thing with iron ore. And we could see some very interesting things. For instance, chip production, I mean, semiconductor production has blocked the automobile industry for the last 6 months. Now, many of those chips are made in Malaysia because that's where the factories are. And Malaysia has now announced that all factories are back to normal. So as you would expect, once the economy suddenly freezes, which had never happened in the past for almost a year, well, restarting is not so smooth. And if transportation is difficult, then you may be missing a small part, like a very small semiconductor, but then you cannot finish the car. And the car industry is a huge industry in terms of employment, investment, etc. So many of these things are now correcting. For instance, the congestion in Los Angeles Harbor, which is the important one for the US for all the trade with Asia, is now 30% for the now down 30% for the last 2 weeks. So as we have seen prices explode because of these bottlenecks, they will go down as the bottlenecks open up. Now, and that we can see, by the way, that the inflation for goods is much higher than inflation for services, where there has not been such a lockdown. And voila. So we see inflation, in particular in durable goods. Now, this means that once many of these things are over in the next few months, inflation will go back to normal. Now, since governments have had a very, very stimulative monetary and fiscal policies to compensate for the impact of the pandemic, we may finally see a little bit of inflation. I mean, it is important to remember that for the last 15 years, inflation has been below target in all the advanced markets. So this may be going back to now finally to target, and we may see inflation now normalizing around 2%, which would imply that interest rates eventually would stop being negative and go up. But I mean, let's remember, they're still negative. So even if they go up, they're still very, very low. I mean, last time the market had these multiples in the 90s, interest rates in the US were 4, 5, 6%, and now they're 0%, so 1%. So inflation has been, the inflation we see is pretty much a function of, for the most part, bottlenecks. Also part of it is the effect of very stimulative policies, but not of it is that way. I mean, you see the three things at the bottom, natural gas, Brent and copper, well, they are not going down. And they're not going down because they are not the result of a particular bottlenecks brought in by the pandemic, but the result of 10 years of underinvestment. And as a bottleneck can be solved in a few months or weeks or whatever, depending on its nature, underinvestment of 10 years, well, I won't say that it will take 10 years, but it will certainly not take a few months. So we see that in the case of energy, particularly in metals, this increase in prices, which feeds to inflation eventually, is going to probably be there and may even go higher. In fact, if we go to the next slide, so we tie up with the third topic, which is the energy transition and investing. Well, this is the point we're making. I mean, people have been talking a lot and mostly talking. I mean, I was going to say doing, but not that much doing, about the energy transition, which is fine, and that's what's going to happen. Of course, that is what is happening in a way. But we have to realize as investors and as citizens that it will take much, much longer than people seemed to imply in some of the statements being made. And that in any case is going to take an enormous amount of investment because that investment has not been made. And copper, for instance, cannot be just produced by some sort of magic. I mean, it just takes billions upon billions, and particularly years upon years of work to increase a production. Now that has not been done, and it is going to now, it has to be done right now. So we can see a few points in the next slides that show, how energy simply is not optional. If we look at the next slide, you see, this is a funny slide, but on the left, you have world GDP, and on the right, you have energy consumption. Now, these two things are intimately correlated. I mean, the only reason that we are richer than we used to be for the last 500,000 years is that now we have energy to do things which in the past we had to do by hand. And of course, by hand, you cannot travel. I mean, by foot, you can travel, but not that much. In fact, using a horse is already using energy. And this is what mankind did for forever, until particularly with the steam engine, mankind learned how to unlock the energy that is embedded in fossil fuels, like coal. Of course, we had been using the energy of the wind in the past, and that's how all the sailing was done. But the limitations, obviously, compared to steamships, are obvious. Now, that if we can see, if we want to maintain our GDP, our standard of living, we need to maintain our level of energy. So we cannot simply go down to use less energy, and as we'll see later, because 80% of mankind is not using much energy anyway, and they want to. So if we go to the next slide, there you see how we have been using less energy, but this is the energy by source. Now, 85% of it, in fact, it is a bit more, because the statistics counts firewood, which is kind of a funny thing, and it's estimated because it cannot be measured. But 85%, 84.3% comes from fossil fuels. That's a fact. And as I said before, we cannot just use less energy or much less. In fact, we are using more every single day. So we have to create the whole system from scratch if we want to get rid of this. Now, a very interesting part that is underlined here in red, is a very small print, is that over the last 20 years, this proportion, I'm saying proportion, the total amount is much higher now than 20 years ago, but the proportion of energy that comes from fossil fuels has gone down by 1.8% over 20 years, not per year, but over 20 years, which comes down to basically nothing. That's not because people don't want to, it is because it is very difficult, or rather, it is practically impossible to suddenly stop using fossil fuels and maintain the same standard of living. So since people are not willing to drop their standard of living, and in most parts of the world, they want to increase it, well, this is not happening, and it is not going to easily happen. So we have to be aware that this is, as we can see in the next slide, and this is very important because here in Europe, we may forget about this, but the consumption of energy, it is extremely skewed. The 10% of mankind which is richer, which means basically us, is consuming much more than 70% of total energy. So no matter what NGOs say, no matter what people say, the people of Africa, of India, of Latin America are not going to give up on their desire to try to live a little bit like us. And we do not see the people of Europe, for instance, suddenly deciding to give up 50% of their income, which is what it would imply to reduce our energy consumption. Energy is not optional. Energy is the source of our GDP, of our income, of our standard of living. And total demand keeps increasing, even if efficiency improves a lot. And we just put a small example here, but there are many, many more. Airplane engines have become 3 times more efficient, so it takes 3 times less fuel to fly from one place to another, but the amount of flying has multiplied by 55 times during that period. So the total amount, of course, is up 20%. And just to finish, a couple of points is that you can see here, fossil fuels are not only used for energy, but also for many other things for which there are no clear substitutes, like making steel and cement. People forget that every single windmill has 2,500 tons of concrete at the bottom, so it doesn't tip over when the wind blows. That is cement. That has to be done, and it is done now. Of course, all these will eventually be substituted with non-fossil fuels, but the amount is staggering. And then what's happening, we don't have the investment to do it. And as we can see in the next slide, funnily enough, most of the new things require an enormous amount of metals and energy to be made. I mean, the world has 1.4 billion engines, vehicles that use internal combustion engines. Now, just building 1 billion new things to substitute for those will take huge amounts of metals and energy. So people are going to continue doing that. There has not been investment, and investment has to come. So prices are going to be very high until investment recovers. And that's the point we wanted to make on this kind of environmental things. So do not be too, flabbergasted by this energy transition. From an investment point of view, is going to be very gradual, and it's going to take a very long time, and it will give us good opportunities. So I leave it to Marcos now, I think.
Yes, thanks, Carlos. Good morning, everybody. Thanks for joining. Basically, I'm going to wrap up a little bit the performance this year of the two funds, the classic and the natural resources. Then we'll be diving a little bit on some of the natural resources, space, commodities, and energy, because energy is a large part of our investments right now. Can you move to the next slide, Alex, please? On the classic fund, this year is being a very good year. The classic is recovering from COVID. Basically, we are up almost 30% year to date. The net asset value is 515. Best sectors, technology, energy, and financials. Most of the sectors are doing fine, just a little bit more disappointing are mining and healthcare. In terms of the best stocks, ASML, ING, Devro, and the oil stocks, these are all up more than 50%. And in terms of laggards, as the book is doing very well this year, just I would mention Grifols, which is underperforming, but we are slowly buying, so we don't see any issue here. In terms of updated numbers, we updated the intrinsic value of the fund. You know that this moves when the mix of stocks move in the portfolio, when we update the models. We have 735 per share. This is the target for the next, let's say, 2-3 years. Return in IRR 14%, and we set a target for next year of 575, so another 10%. This is not really surprising. The classic has made 9% per year since inception. This is very close to our target, and this is important to remember. 10% is doubling every 2 years. It's multiplying by 4 the investment every 14 years, and it's multiplying by 8 every 21. So, we are long-term investors. We want to profit from the magic of compounding. I mean, staying there in the long term makes a big difference. Could we aim at, this is a question we get from time to time, could we try to do 20%? Clearly we could set up a portfolio with a 20% return, but the level of risk would probably be very too high. So, for us, capital protection plus decent return is the key in terms of investments, and we want to protect capital and not lose money in any of the trades. Please, Alex, if you can move to the next slide. This is the performance of the classic. So this is what we were commenting. I compare these two charts here. One is comparing us to the value index since inception and to the MSCI World in Euros. So we are adding a couple of points of alpha, which doesn't look too much. A very good friend of mine who's a professional was telling me, well, 2 points is not too much, but 2 points, if you go over the 20 years, look at the difference. The classic is multiplied by 5, and value index has multiplied by 3. So it makes a big 2 points of IRR makes a big difference. It's maybe 25-30% per year. Please, Alex, there's another chart that I wanted to show, which is basically benchmarking some of the value funds out there. So here we selected 2 or 3, Warburg Value, 2D Brown, and DJE, and basically the performance are not that dissimilar. So 10% per annum for the last 10 years, and the bracket is between 8 and 10. So value works no matter you compare it with other things. I'm going to move to the classic holdings. This slide, I like it very much because in one slide you can see half of the classic, And half of the classic, it's in 10 stocks. Okay, and if you look at these names, you will, agree with me that we have three characteristics. There's business quality. All of them have business quality. They have good management teams, and the strategy is focused and clear, aligned to the minority shareholder. So the portfolio is quite a bit concentrated. We don't really take a look too much to growth or defensive or value or other factors where the markets are obsessed with. We have these 10 names that are half of the book. It is very concentrated, but also well diversified, because look through to different businesses. Here we have banks, we have plasma, we have cement, we have oil, we have cleaning, we have aerospace, we have catering, we have casing for sausages, etc. So really, this is half of the classic, and you can very well understand what is the target. It's protection of capital at 10% return. I'm going to move to one of the holdings, which is a big one. I think now it's around 5% of the classic. It's Heidelberg Cement. Main idea on the investment is the management change that they did in 2020 with a new CEO, a new team, and they changed the strategy. The fundamental here is clear. Cement is a good business. It is cyclical, of course, but it ends adopting an oligopolistic structure because transport is very expensive. You cannot really transport cement or ready-mixed concrete all over the place. The limit is maybe 200 kilometers around the demand. So basically, the sector ends up forming a local oligopoly, which is able to generate double-digit returns and free cash flows. So the problem of the sector historically has been that the managers have created a lot of cash flow and built and made acquisitions. And most of these acquisitions were at the wrong price and at the wrong moment, like Heidelberg that they bid for Hanson in 2007 and Italcementi in 2016. And we think these were mistakes in our view. In the next slide, you can see what the new management is now following through. And all of us would like to hear these things from most of the managers. So what do they want to do? Improve margins, lower cost, selling non-strategic assets rather than buying them, improving the balance sheet, which is already done. They're going to do a digital transition, which I think most of the corporates are involved in. This is very important. They are going to accelerate the decarbonization. And in this aspect, Heidelberg is one of the leaders. And they're going to return excess to cash flow to shareholders. So, everything we want to hear is happening. In the next slide, you can see probably the main problem of this investment is carbonization or decarbonization and energy transition, because this will probably push Heidelberg to raise expenses and investments. But we think that the ESG narrative is not really fair. So I would comment only 3 points. Basically, we think it's as important to invest in polluting sector as it is to invest in green assets, because in the end, polluting sectors need to decarbonize. So if we invest in them and we push the managers, we will have a huge impact in terms of emissions. So I don't think that the ESG ticket shouldn't be put in these companies. As the second factor, I would highlight this oligopolistic structure. So we think that even if Heidelberg and the rest of the players invest more and add cost in order to decarbonize, this will be passed to the end consumer. So we will see that through pricing. These guys are oligopolistic, so they will be able to pass it. And finally, just one comment, Heidelberg is one of the leaders in terms of ESG. They are investing in several pilot projects in terms of CCS, carbon capture and storage, and in terms of alternative fuels, and even they have a green concrete stuff. So they are doing their bit, and is one of the leaders, as I said, in this path. Last but not least, there's important infrastructure plans that are going to start in the next few years. In China, it's ongoing. In the US, it's starting. In Europe, so this will be a tailwind for the sector. And in the next slide, you can see the valuation, which is ridiculous. If I apply the average of the sector in my history, it's 8 times EBITDA. Of applying this, I get 100 euros per share. The stock is trading at 65 now. If I apply 10 times EBITDA, which is the peak multiple when the cycle is a bit, on the upward trend, normally the stocks move to 10. So I already go to 145 that we are not putting in our numbers, obviously, but this is what normally happens. And finally, just a comment here, they sold non-strategic assets in California for more than $2 billion, and the multiple was more than 15 times. So really, the stock trades at 6, and they're selling assets at 15. So it's a kind of a strange stuff, and in our opinion, is due to decarbonization. Give me a couple of minutes to talk on a name that has been a pain in the neck for us in the last few years, which was Pandora. So we jumped in the stock in 2017, and the things were bad. We averaged down slowly, patiently, as we do for 3 years. And now I wanted to wrap up what we think we missed. We missed first the company's internal damage done by the management, that they were really running for growth and not for profitability, and they mismanaged the company for some years. So that we didn't really understand well. And second, Pandora dependence on its commercial success, which is difficult to judge from the outside. So they depend quite a bit on some platforms and charms, and it cost us to understand a little bit more. And the stock has been a roller coaster, up and down. Started in 11 at 30 Danish kronas, went up to 1,000, so multiplied by 33 times in 5 years, then down 80% in the following 4 years, and now back to almost the peak. It's trading, I think, 940 now. So it's done well for us. In the next slide, I wanted to wrap up a little bit what happened. So basically, after this experience, our strategy analysis was correct. So, and the key word here is strong barriers to entry. So they had advantages, they had scale and cost distribution, they had switching costs thanks to the platforms and the charms and some network effect. So, we are happy to have been correct in the strategy analysis. So basically the key thing was the management change in 2019. They rebuilt the company completely almost in the last 2 years. And now this is having an impact in returns and in the company's earnings. So very happy to be there, and all is good in Pandora. I'm going to take the next 5 minutes to go to the natural resources. So the natural resources is doing also very well this year, almost up 50% to now, to mid-November. The net asset value is around 127. A lot of people ask us, is this the end? And, we want to insist this is just the beginning, because we are convinced that this is a new commodity super cycle. Basically, normally you have a boom-bust cycle, as Carlos was explaining, because this which is a long cycle, because the sector has difficulties in developing new supply. So this is the normal cycle. It's a long cycle. It takes 5 to 10 years down, another 5 to 10 years up. But this time is a bit different because we have 2 cycles overlapping. We have the normal commodity capex cycle, which follows 10 years of underinvestment. And we have the capex needs from the energy transition. So the energy transition is something that lays on top of the normal cycle and complicates the thing. In the performance this year, energy has been the greatest performer, up 50% plus, following by mining 30%. In the next slide, you can see the look through where we are invested. So now, because this can move quite a bit, last year we were heavily invested in copper, we reduced it a little bit. And this year we've been invested basically in oil and gas with half of the book. And then the rest of the commodities in the look-through companies here, you see that copper is more or less 15%, nickel around 8-10%, uranium 10%, salmon 10%, and cement 5%. In cement, we are slowly getting grip, and we may end up buying more if in the end we are convinced of our thesis. Please, Alex. Yeah, this is the same slide from the classic natural resources fund. We revisited the numbers. The IRR currently is 14%, intrinsic value 172 euros, so very good upside. And you may ask why the IRR is similar to the classic. It is similar because we do our numbers on a mid-cycle valuation. Okay, this means that we take average margins and average returns and average commodity prices for the cycle, commodity prices at incentive levels. And this, gives you what is the mid-cycle valuation. But, this sector goes from one extreme to the other, like a pendulum. So doing an exercise which is not very fundamental, but, can reflect a little bit the upside we expect we have in this fund, is last year the fund went to 70% below the intrinsic value because the market was, afraid of the COVID-19 and facing a recession. So going to the other extreme, if I apply this 70% on our intrinsic value, but on the other extreme, on the positive extreme, we would reach 275. And we are convinced that this is a likely scenario in the next few years because we have seen several cycles and it's always the same. The sector doesn't stop in the middle, it goes really, really high and really, really low in the peak and the trough of the cycles. In the next slide, Alex, please. Yeah, just a final one for me, and I will pass it through Urs. Basically, how we try to add value, focusing on tier one assets, very important, sizable reserves, quality reserves. We don't like, new companies that are small startups with tier three assets. This is very risky. Even tier one assets are too risky. We look for good management teams. This is obvious. This sector is full of undisciplined people. We like good management teams that are really solid. We try to go to low risk geographies. This is not obvious because some of the areas where we have the commodities like Congo are not really the safest, but we try to do that. We keep an eye on valuation, as we stated with the net asset value and the IRR, and we normally do not invest in majors. And I think that's for the wrap up of the two funds. And I guess Urs is going to go a bit deeper in the natural resources space.
Thanks, Marcos. I just want to elaborate a bit about our experience and what we believe are the good assets, because here that's a bit our philosophy. We don't like to be far away from cash flow. We like to be at cash flow because that's our experience. Risk reward is the best. So we like to have companies, which the best would be when the capex phase is ending, and after years and years of a lot of investments and cost overruns, etc., these assets are now bearing fruits and starting production. A good example is one of the biggest companies in the world is Gazprom, which had huge investments, Power of Siberia, 80 billion. It costs a lot of money, but now starts delivering gas for 30 years to China, and the company will distribute the 50% of the market cap to its shareholders in dividends for the next 2 or 3 years. And obviously with the actual gas and oil prices, this could be rather quicker than not. But maybe on the next slide, Alex, this is a bit an example about mining in the case of an example of the high-grade nickel reserves in the world. You just see Norilsk has 7 times more reserves than the whole rest of the world. And these are not some small, strange companies, the rest. These are the BHPs, the Glencores of this world. And obviously, if you would buy a mine with a PE of 10 and you have only 5 years mine life left, your share is 50% overvalued and you're going to lose 50%. So I think this is very important to keep in mind that you have a capital intense business. You need long reserve lives and obviously good grades. And maybe on the next slide, Alex, this is an example about a sector which now came up a bit in the news and so, but we are owning the 2 major assets in this sector, which is in the case of uranium, Kazatomprom and Chemical, which supplies 50% of the whole world's uranium from mines. And you see, for example, the grades in Chemical's 2 mines. I mean, Cigar Lake, which is in production, mines 15% grade. This is 150 kilogram of yellow cake per ton. And the average grade of MacArthur River, which is on care and maintenance at the moment, is 7%. But this is a very long mine life. So they were also mining until they stopped 15% grade. And I just have to tell people that here historic uranium deposits have been mined with gold grades. So it means a few grams per ton, of course, in open pit operations. And this is underground. So very different economics. Maybe on the next slide, you see Kazatomprom, which soon is going to distribute double-digit dividends on these uranium prices. Is the major supplier. It has joint venture with the whole world. And maybe on the next slide, Alex, you see the cost producers, and I want to have a quick word on that, because if we would take, for example, the example of iron ore at the moment, which now went from 200 to 100, after from 30 to 200, because there was a lack of energy and and the cut of energy supplies to the steel makers, so less steel being produced, a bit too much iron ore, price is halving. And now you have the situation, if you're in the low cost producers, you still make a lot of money, which, for example, is the case with Kazatomprom, even with very low uranium prices. They had always a nice dividend yield. And, you know, obviously, if prices go up, this is all going up. They distribute 80% to shareholders. And if you're on the marginal side of the production, you're virtually an never ending out of the money call. And sometimes you may be in the money for 1 or 2 years, but then, you know, you're losing money again, and then this is not worth to be invested. So this is a bit what we try to say, or Marcus said, with focusing on the good assets. And maybe now this story about reserves and exploration, you know, let's just try to explain a bit, you know, what these are, because reserves are only the things which you're able to mine economically. So you obviously have to put a lot of assumption in the model, mainly the commodity price, the cost, and the cost to build the mine. But most of a ore body is never going to be mined. Maybe on the next slide, Alex, this shows a bit, you know, the scale of even a good ore body. And, you know, at the end of the day, resources are they're not worth anything if they cannot be converted to reserves. So most of the ore body will never be mined, and actually this is worthless at the end. Or you are able to convert it into reserves and then mine it somewhere, which obviously implies a lot of money and building a mine. So you have just to be careful if in a topic it comes up and now, oh, we buy an uranium company and we have a very nice ore body and so. And by the way, in the good projects, you're anyway not invited to take part. For example, in uranium, the best uranium mine is in Russia from Rosatom. It's going to be built probably towards the second half of the decade. This is the largest uranium ore body, but very low grade and obviously huge. But, you know, this is going to be done by the Russians themselves and the state, which is Rosatom, and you're not invited to take part as a shareholder. You're only invited to fund every year exploration of marginal projects, which are usually not coming to production. This is just a statement if somebody wants to read about what are really reserves. And maybe the next one, Alex, the resource about the definition about resources. So we can skip that, Alex. Everybody can read it himself. And then maybe something about which you should be a bit careful. And now all these companies running around being lithium or whatever, you know, even in resources, JORC standard is the Australasian standard, how you measure resources. There's a Russian one, GKZ, which is similar, Canada CID, and you are forced to state them. But obviously this is like everything else, like the SEC statements. You're in a presentation to somebody when you want to raise money, you can talk about everything and just name it resources. But I would just advise to dig a bit deeper into that if somebody wants to be really in these exploration companies, which is something we are not doing, to the reason I explained. Maybe the next slide, Alex. And maybe this is just an interesting thing. In the example again of Kazatomprom, if you just take the existing assets which are producing and you check out when they went into production, no, it was mostly in the 70s. So even the best thing is already producing since a few years. So that shows a bit how long that takes, you know, if something goes into production, but of course also how important it is to have a long mine life. And maybe the next slide, Alex. This is obviously again the reserve statement. So I think I commented on that already. And just a few pictures, you know, this is a corporate Panama from First Quantum. It did cost 7 billion. Maybe the next slide, Alex, shows a bit how capital this is. The next slide, Alex. And something which is also important, maybe the next slide, Alex. If you take again the situation of iron ore, maybe the next slide, Alex. This is just photos. And you know, what happens also in a commodity bull market, there's no commodity bull market with cost inflation and capex inflation. Now the Fed can say something about producer price index, what they want, but if you want to build a mine, you have to buy these things, you know. And obviously, if you can imagine, if you want to buy a mine, let's say a new iron ore project, your cost inflation or capex inflation has probably rather been 30% or 40% already in the last 2 years, despite what the Fed is saying, because these things have gone up in prices. Just look at the amount of steel it takes. And this is what I always reminds me of a funny anecdote 15 years ago in a last bull market when the CEO of BHP Billiton complained about the rising steel prices. But obviously he's the biggest exporter of iron ore and coal. So what I want to say is that a mine on paper is getting massively more expensive in a commodity bull market. And if you already have bought the equipment and built the mine, you're getting the benefit from the replacement value, which is going up. And just to finish, I want to go back to the iron ore situation. Now we have 4 suppliers. Half of it comes from Australia, from 3 companies. And you know, these companies have now gone down in prices about 50%, the share price, and they will now cut the dividends because they're distributing 70% to shareholders. And because iron ore went from 200 to 100, we will see dividend cuts in spring. But you know, with prices of $90 and production costs at 20, they're still making nice money, and you just get 7% dividend if you're BHP shareholder, probably instead of 13, and you're not going to die because of that. But the problem is, if you want to build an iron ore project in let's say in Africa, and you already have a COPEX inflation which is probably 50% during the last 3 years, so your project is multiplied by 3 times on the investment cost. And then you have the second thing is, you know, that's the transportation, because iron ore is bulk. That's why Australia is in a good situation. Now, if you're further away, or if you look at the iron ore price, it's the price in China. A quarter of it, as a rough rule of thumb, is transport. But you know, if you have double the transportation kilometers, and everybody knows what happened to shipping, you know, your iron ore project in Africa is probably already out of the money and not viable anymore. So it shows a bit how quickly it goes. If a commodity price goes from 30 to 200 back to 100, and you have cost inflation. So if you're just a mine on paper, you're probably already worthless because you're not making money with this all this capex inflation and, you know, a decline in commodity prices. So this is a reason why historically you're not really outperforming the good assets which are being built already. So you have to go to the good assets, and you benefit from the rising replacement value of inflation because you already own the trucks, you have already built the haulage system, and so on. And that was quickly a bit about our philosophy. Maybe I can give it back to Marcus.
Yes, thanks, Urs, for the comments. I'm going to go fast to the energy. Why? Because energy is basically half of the book in the natural resources, and it's 20%, around 20% in the classic. It's a high conviction that we have. I'm going to start with 2 trends that we are seeing in terms of capital. The first one is capital is fast leaving fossil fuels, mining, cement. All CO2 emitting industries are seeing capital living, and this is happening for the last few years when we still have decades of dependence on fossil fuels and traditional industries. So capital is living when we still have decades of demand. And the second trend is that capital expenditure is moving very fast towards renewables and non-polluting industries, which is very good, but this move is very slow and would also take decades. I mean, it's impossible to accelerate the change of the global generation mix. So these 2 trends are converging in something we call the green paradox, which, you know, don't misinterpret us. We want to protect the planet, and we are greener as everybody, because it's common sense. But here the problem is that we, you know, the green paradox is that we must keep investing in fossil fuels to become greener, because, you know, we still have decades of demand of them. And we need to invest in these companies and in these fuels in order to push them to decarbonize. It's going to be impossible to get out from one and get it in the other one without a transition. And the transition is going to be decades. In the next slide, you know, we are not really willing to look clever here, but, you know, we propose 8 ideas to help decarbonization, which makes sense. The first one would be moving from coal to gas. This is easy. Gas could be considered clean in a transition, and really the CO2 saves would be huge. Then do not demonize CO2 emitting industries. We need to help them, to invest in them to decarbonize. This will have a huge impact in the global warming problem. We need nuclear. We still do not understand why more countries are not joining the group. The UK, France, and China, obviously, and Russia are leading the pack here, but we will see other people joining, because without nuclear decarbonization, it's impossible. We need to keep promoting renewables, of course, and energy storage R&D, of course, at all levels. We need a global CO2 pricing, which is, we saw a step in the COP 2026, but it's not yet defined, and it will take time. And we need CCS, carbon capture infrastructure. We need to stop deforestation. We need to help developing countries. And maybe, and this is the challenging part, and the last suggestion is the change in consumer behavior, because, we've had 50 years or even a century of very cheap energy and very abundant energy. And we feel with all our numbers that we are going to a more expensive phase where energy has to be, taken care of. In the next slide, I'm going to dive to the oil sector very fast. Inventories are running to the end. Basically, if you look at consensus and everybody, the spare capacity, which is now around 5 million barrels a day. Remember that demand is already at 100, so numbers are easy. 5% spare capacity will, come to an end basically in summer of next year. So no more excess capacity. Next slide, Alex, please. If we take a look to 2025, we are already seeing problems because spare capacity gone next year. New projects can add maybe 3-4 million barrels a day. Shale oil can add another couple of million. Maybe Iran can add a couple of million more. But, taking account declines, we have a deficit inside. And in this chart, you see it already 3-4 million barrels a day deficit before 2025. And the worrying slide is the next one, because you will see the same chart, but looking at 2030. So we are at 100 in 22. Demand will grow by probably more than this, but let's say 7 in the next 10 years. And then we have the decline. So if you add up everything, we have a need to find 20 million barrels more, okay? A need of 20 million because demand is still growing. In the next slide, you can see where we can find these barrels because the barrels are there. So we go to the cost curve and you need to go to the 20, in the axis. You go to 20, then you through the line and you find that we need to consume all these reserves up to back end. And there the incentive price should be, so the total cost or the incentive price should be around $80, $85. And as Uz was saying, this curve is moving up due to inflation. So transport is up, energy is up, all the costs are moving up. So this curve will slowly but surely move up. So we see that incentive prices are going to be probably in the 90 region in the next few years. Next slide, just a conclusion here. It's for us, it's a very clear, and this is why we are overweight in both funds. Crude supply is constrained due to declines and very much reduced spending since 2013. Also, there's a change in regime in the sector because it's very, very disciplined now. Demand is very sticky, and we don't expect demand to fall, at least in this decade, no way. So we need these 20 million barrels to bring 20 million barrels. This means a capex of 600 billion, which is massive. And we have two problems. The first is that nobody wants to invest in oil because it's a polluting industry, and we are all of us worried about warming, which is correct. But we need to invest because we are getting out of the stuff. And the problem too is that demand is inelastic. This means that most of us have still gasoline cars or diesel, and all the transport is based on fossil fuels, which means that basically prices, if there is a problem in supply, prices will move up. And the the balancing factor will be prices. So, our thesis is oil prices should go to incentive, maybe $80, $90 per barrel to support higher capex. And this will take maybe 5-6 years. And a deficit will lead to much higher prices in the three-digit region. So I think this is over for me. I will pass the mic to Alex. Just a couple of slides, sorry, on the valuation. So it's basically in line with what I was saying. People ask us if this is the end. Look at the valuation of the energy sector, or the oil sector. It's completely crazy. PE 2022, 11 times. Price to book, 1.5 times. And this is, the historical mean is 16 times earnings, and the peak historical is 20 times earnings. So here we have a re-rating and an upgrade of earnings that is coming in the next few years. The sector is super cheap, and we think it's going to make a good performance in the next few years. If you take a look to the companies, free cash flow yields are in the region of 15 to 20%. Next slide, Alex, and here you can see the reaction. So oil prices are up massively and the sector is down. Again, and we think that like in cement, the main cause is the decarbonization and CO2 emissions polluting industries and the whole capital moving to ESG. If I'm not wrong, this was my last slide, so I pass it to Alex.
Thanks a lot, Marcos and Urs and Carlos. Just from my side, a couple of few slides left, and then we get to the Q&A session, and you can actually chat, ask questions, and then we can come back to you. I would like to give you the conclusions on the Net Resources Fund. We believe the Net Resources Fund is a perfect legal stone to have the right puzzle at work for this next levels, and we really believe it is going to be 2 cycles in parallel, as Marcos has indicated. You have, first of all, the cycle that is extremely sticky demand still, and then on the other hand, you have a situation that miners with reduced supply still have accelerating demand. So you have those 2 parallel moves that are for sure giving a fantastic cushion to prices, and we believe strongly that in energy and in mining, the prices will be very, very attractive. As we have seen and heard this morning now, valuation in the energy space is extremely attractive. We have really moved at the end of last year, beginning of this year, substantially out of industrial metals because they became quite fashionable. And we increased substantially energy because we clearly came to the conclusion that because of this sticky demand for the next 10 years, we cannot just get rid of energy. And last but not least, I think it's a very important point. We believe strongly that our fund is a perfect puzzle to also protect your clients' money in your portfolio. What I would like to add, just 1 or 2 slides, is you see here that in the last energy cycle from 2002 to 2007, when oil prices went heavily from 20 to above 100, a Royal Dutch total return in the same period, with including the dividend, was 34.5%, and the C&Q multiplied by 5. We believe clearly in mean reversion when it comes to sector rotation. If you look at here, mining relative to MSCI World, we can easily double, just go to the middle, but we are pretty much convinced that we're going to see a repetition of 2001 to 2007. More extreme energy, further below than the year 2000, because interestingly, the mining space, the rotation among sectors was at the same level as the year 2000. Here in energy is actually substantially lower because of what we have discussed. Nobody wants to have any energy any longer. But if you look that here, mean reversion would take place, energy already from that could actually triple. Our fund over the last 6 years, you see here clearly that we are a high beta puzzle. So basically we are losing more in the phases of COVID, but we did pretty well already in 2016, going substantially higher than the market. Here the market being the S&P Net Resources Index. And if you look at the performance since the trough, we really have substantially outperformed this index by 63% in 1.5 years' time. So that's basically the end. And with that, let me go basically here and we can have some questions. We got actually the first questions was mentioned already when Carlos was speaking, and it was about inflation, and could it be that inflation could overshoot?
Well, if I may say a word on that, well, it may, but inflation happens when there is more money, there are more people willing to buy than people willing to sell structurally. So either because, there's a very lax fiscal policy or monetary policy, or because there are no chips and then nobody can make a car and then people want to make cars and cars go up. Inflation only happens, of course, when the situation is permanent, when it happens every year. Systematically, governments, print more money than they can make things. Now, if we go to the world before COVID, so which is not that long ago, 2 years ago, governments or central banks had spent 15 years trying to fight deflation, not inflation. Negative rates were there already well before COVID, and real rates were not going up. Nominal prices were not going up. Now, since COVID started, the world capacity for production has not gone down. We have bottlenecks, but all the chips factories are there. All the ships that have to transport the containers are there. Now, some of the containers are in the wrong place, so they cannot be transported. So the price of transportation goes up. And then the things do not arrive, and the things that do arrive then go higher in price because there are fewer things, etc., etc. But these are truly bottlenecks. As long as the production capacity of the world is the same as it used to be, the situation should revert pretty much to where it is now. Will governments from now on and for the next 5 years keep printing money, keep lowering taxes, keep increasing deficits? Well, maybe. And in that case, of course, inflation would go up, but we find it unlikely. At the end of the day, this has been a temporary dislocation, and we should go back to the ex-ante situation. And in fact, we are going back to the ex-ante situation pretty fast. So, of course, there is a risk of inflation. Of course, not of course, but probably inflation will be higher going forward. But we'll repeat, being higher going forward means not having negative interest rates. That doesn't mean having 5% interest rates. So things should normalize a little bit. There is a tail risk, of course, there is always a tail risk for everything. We could get into deflation once all these bottlenecks. Somebody was talking about the ketchup bottle economy. I think we all have the experience that we try to put ketchup on the hamburger, and then the ketchup doesn't come down, and it doesn't come down because it's very sticky. And then we tap the back of the bottle, and eventually half the bottle comes down onto the hamburger. So we could see now some of that ketchup economics, ketchup bottle economics coming on. So there is a tail risk. And for that, by the way, as Alex was just pointing out, natural resources are a very good investment as a hedge, apart from all other things.
Thanks a lot, Carlos. Marcos, we have a question for you. It was asked, what is the weighting on natural resources for the Classic, and how has it moved over time?
Okay, and the Classic, we have more or less 20%, which is probably maximum weight in oil, energy oil, basically oil and gas, 20%. And we have 3-4% in copper. Last year, at the trough, I think we almost were at 15-20 in copper and 15-20 in oil and gas. What the main change this year has been selling quite a bit of the copper, because you know that copper has moved very high in terms of a spot price. It's $4.3 a pound. So we sold a little bit we sold quite a bit of the copper exposure, just waiting for another opportunity to rebuild it. We think that China may slow down a little bit in the next 6 months. We think that we can take this opportunity to rebuild a little bit more. In terms of the natural resources, you've seen the breakup. The breakup in natural resources is 50% is energy, because you look, the valuation there's a massive gap between oil and mining, because oil is hated due to pollution, whilst mining is green, more or less. I'm talking more about copper, nickel, and the likes, and lithium. They're very liked because of the ESG move, whilst the oil is hated. So there's a big gap in terms of valuation. This is why we are overweight in both funds in energy.
Thanks a lot, Marcos. If I may add, you're absolutely right. The weightings for natural resources went down dramatically in the Classic in March last year, but then we rebalanced heavily. And that was really the due to the fact that we have these 4 risk categories that helped us to sell Viscofan, the largest sausage produced in the world, and we're able to buy more oil and more copper. We have one final question that I would like to take, which is not surprising, Marcos. Somebody is asking about what about the lagger in the energy space, Harbour?
Yeah, you know, we have plenty of names in the oil space, and all of them are up a lot this year. And we have Harbour, which is really a laggard here. You know, we've been doing a lot of work on Harbour. We spoke to the management. The management is fantastic. So we are positively surprised by the management, by the strategy, by the quality of the assets, and by the future. So from a fundamental basis, what is happening this year is all positive. All company, production, cost, balance sheet, and oil prices are going in the right direction. And the problem for us is that there's a bunch of investors that are selling the name because they were there due to the merger between Premier Oil and Kreisauer. So there were bondholders that are selling, and there were some, you know, non-invited kind of non-equity investors there selling. So there have been the lockups took 6 months, so there's still a selling pressure on the name. But just looking at consensus, and consensus, forget about, consensus is not putting $85 or $80 in the models. EV/EBITDA, if you look at Bloomberg, next year is 3.5 in 21 and 2.7 in 22. The average long-term EV/EBITDA of these names is 6 times. So yeah, bad performer, we are slowly buying more.
Thanks a lot, Marcus. I just have received another last question. I think it's worth answering from myself. The question was coming that if somebody looks at the Bloomberg, at our fund relative to the MSCI energy index, it seems that we are highly correlated. And that's a very technical fact. We started with the fund in 2005 as an energy fund. That's why the ticker is called LTIF, Global Energy Value Fund. And in 2007, we were asked from our clients, why don't you start a separate mining fund? And those two, we merged in 2011-12. So basically, don't look at the track record from 2005 until 2011, because at that time, it's purely an energy fund and separately. And of course, then it looks like mirroring the MSCI World Energy Index. It's different if you then start basically in the last 6 years, if I may go back just to this, what we compare ourselves here is the S&P Natural Resources Index, that is including energy companies as well as mining companies. With that, I would like to thank you, actually, all of you, and the SIA team is very, very happy to follow up with questions, with personal meetings, if possible, and of course, Zoom is just a mouse click away. Thanks a lot and have a great day. Take care. Bye-bye.
Thanks to you all. Bye.
Bye-bye. Thank
you. Bye. Take care.